Good afternoon, everyone, and welcome to our January Tax Tuesday webinar. I'm Clark Boyd with Molen Associates, here with Kathy Stump, who is our Tax Advisory Services Manager. We're glad you're joining us. The purpose of today's webinar is to kick off the filing season, and it's intentionally designed to help you feel more calm, prepared, and confident going into the next coming months. Tax season has a reputation for being stressful, but in our experience, this stress usually comes not from taxes themselves, but from scrambling for documents, being uncertain about what's changed or not knowing why you may owe, and not knowing what actually matters this year. Taxes are always changing, so we want to take out some of those pain points before they show up. So a quick note on what's coming up. So this is like I mentioned, it's our last monthly Tax Tuesday. Starting in January, we'll be moving to weekly webinars through the end of March. That way, as we're learning things throughout the tax season, as forms may be changing, whatever it may be, we can keep you updated. It's also a good chance for you to ask us questions. So think of it as kind of an open office hour. So bring your questions, happy to answer those that we can. Throughout tax season, we'll talk about individual filing updates, small business deductions, entity planning, IRS notices, really the whole gambit. So jumping into today, Molen Associates is a tax and accounting firm started in 1980. So we've been doing this a really, really long time. The purpose of the webinar, like I said, is to help you get organized, go over the one big beautiful bill, some of those 2025 tax season updates, go over the most common filing mistakes we see and how to be proactive with them. So we want your tax season to be calm and planned out. We want you to be in charge and really take control of how much you owe or get back. Some of that is proactive planning, and that's why we've been doing these webinars through October, November, December. So we want you to do what you can. But really, we want you to understand your tax situation and plan proactively. So jumping into the first, there we go, there's the second slide. So this first section here, document organization. This is probably one of the biggest things you can do now. It's still early, it's only January 20th today. Most tax forms haven't even come out. I think I've seen a few 1098s for mortgage companies, maybe a couple W-2s, some 1099s are starting to roll out. Most employers have until January 31st to file those, and it may even trickle in a couple days after that. So you may not get your W-2 until mid-March. Most banks, for example, Fidelity, Charles Schwab, you name it, they don't issue their 1099s until mid-February or even late February. And sometimes those don't even come out until, the corrected versions don't come out until mid-March. So there's a lot of documents, especially if you have a higher complexity on your tax return. So I would recommend looking back at your last year's tax return, see what forms you needed, what W-2s, 1099s, whether it's interest, dividends, contract work, retirement distributions, mortgage statements, all of those things generally stay pretty similar year over year. You can just make a list of, hey, here's what I'm waiting on. Your property tax statements, childcare, education documents, charitable contribution records, all of these things you need to put together. I use a Google Drive, just a Google folder on Google Drive, and I put everything in it for 2025, and I look back at 2024, and I just use it as a checkbook. I'll put it on a Word doc, and I'll cross them off one by one until I get it. So I know when I have everything, that's when I put it into a folder, and I give it to my tax guy. So it becomes really easy. The worst thing you want to do, and we'll get to a little bit later on, with one of the errors to avoid is filing without showing your income, or if you're missing a form. We file, Kathy, correct me if I'm wrong here, but probably a dozen people that are missing the marketplace health insurance form. We ask for it, we remind people, but if they say they don't have it, we go by their word, and without fail, it rejects, and we have to follow up and find it. So
I think part of that is that some people do sign up kind of inadvertently and don't realize that they did. They were just checking it out and didn't realize that they'd created an account. And they will send you that form even if you've never utilized the insurance. And even if you never even really got a live policy, they can still issue that form. And that's one of the checks and balances that the IRS does when they file the return. They know when those forms were reported. And if you file your tax return without that form, they will automatically reject it, even though you might not have ever used it or even really had a policy. The other thing that's a similar situation with that is your IP PIN. And that's an identity protection PIN that's issued by the IRS, usually if you've had some kind of fraud or identity theft. But if you have one ever, you can't ever, you always get one new one every year. You're not able to cancel it after you've signed up for it. And it does change year to year. And we find that mistake happens a lot of times too. We'll get the year before's PIN, or they will not even let us know. Clients sometimes just don't remember that they have one. And that document comes out at the end of December, probably early January. So it's really easy to miss it and not realize that that's something that you actually need year over year for your tax return.
That's perfect. So one other thing I'll add here, and I'll actually move this document over. Hopefully you guys can see this. So this is our tax return intake questionnaire. We customize these every year to be specific for the tax laws in that year. So in the 2025 tax intake questionnaire, we talk about tips and overtime, anything specific to this year that may have changed since 2024. For example, in 2020, we talked about the ERC and the SB, all of those different types of programs that were going through COVID. So the nice thing about this is if you put down you're a business, it'll tell you which business documents we need from you. If you put down your 1040, as you go through to the next screen and you say, I have a mortgage or I have 1099 income, we'll tell you which tax forms you need, just to kind of take some of that guesswork out. That way you're not missing anything. You can go proactively seek it, because we want your tax return to be as accurate as possible. So that's something that hopefully can help. All right, you guys are still seeing the intro slide, aren't you? Let me see if I can catch that up. There we go. Okay, so if you click that link right here, the molentax.com/resources/tax documents, that also has a list for you. And here's some ideas for statements that you may need either as an individual filer, business filer. And then as I mentioned, that intake questionnaire, if you just go through and answer it based on your 2025 situation, it will tell you in everything in green is something that we need. Going on to the common filing mistakes. And if you guys have any questions, feel free to put them on the chat. We'll get to them either throughout this webinar or we'll get to the end. I see we've got a couple coming in through the chat already. So these filing mistakes, number one, as we already mentioned, it's missing or incorrect income. There's nothing worse than missing a 1099 or missing a W-2, even if you worked, and a lot of times this happens if you worked maybe January and February of 2025, and now it's a year later, you've got a new job, you forgot about it. Maybe the W-2 came late or the person didn't issue a 1099, something like that. Just make sure you've gone through your year, thought about what changes you've made. Number two, filing before all forms arrive. This is common, like we mentioned with the marketplace health insurance, the IP PIN, DIY business deductions. So this is a good one. You don't want to be making things up. You want to be keeping it legitimate, but you don't want to over deduct things to increase your audit risk, but you also don't want to under deduct, which means you'd be paying more tax than necessary. So make sure you're documenting things appropriately, but you're taking advantage of all deductions you can. Number four.
One thing I'll say about business deductions, an important thing to remember is that you don't necessarily have to give us every piece of paper, every receipt or anything like that. We more or less trust our clients and, give, the feedback that you give us. This is my deductions. We usually just kind of go with that. We might have questions about them if they look unreasonable. But one of the things that you need to remember is that even though we might not ask for them and they're not required to be filed with your tax return, they would be required in the event of an audit. And even if it's something that you just kind of think about, it's like, oh, I know I spent $400 at Office Max for a new monitor or something like that. If you don't have the receipt, it won't necessarily hold up your tax return, but it will create havoc for you if you have to go through an audit, because that can be up to 3 years. So if you really can't lay your hands on it right now, it'll probably be harder to lay your hands on it down the road. So you just need to kind of be thinking about those kind of things and just setting yourself up for success.
That's great advice. Common filing mistake number 4, ignoring IRS letters. I know this doesn't really have to do directly with tax filing, but this is a really important one because usually IRS letters are informational. They're not always punitive. It doesn't always mean you're getting an audit, but if you ignore them, they never get better. So oftentimes if you open the letter, you adjust it right away. It's usually a simpler resolution than waiting 6 months or a year and waiting until the issue compounds. We found this, especially with business owners, you get a notice of past due franchise tax. Oh, I'll deal with that next year. And then 10 years goes down the road and you've still got this operating business and now you have 10 years of catch-up filings. So that can lead to much worse mistakes. Mistake number 5. This one seems a little different. Letting your kids file their tax return before you do. So this happens oftentimes in college when the kid thinks they're grown up, they get their first job, they make their income, and they're excited to claim their taxes and get all this money back. The problem is if you are claiming them as a dependent and they do not match your same status, your return will now reject. So either make sure they do it correctly, but even better than that, I would say you need to file first and then they can file afterwards, because oftentimes they just don't know what they're doing and it mismatches, and it's better for their return to reject than yours. So, and mistake number 6, as Kathy mentioned, your IP PIN. This changes every single year. A lot of clients think that it's a one-time thing, but it really is every single year you'll get a new PIN. It's for security purposes, so keep hold of that. Anything else to add on these, Kathy?
I don't think so.
Okay. So now jumping into the 2025 tax changes. So these are, go to this next one. We're going to go through these a little bit faster. We have a full webinar on the One Big Beautiful Bill. We did a very deep dive. I think it was October or November. We did quite a bit with this as it was a more newly released. But these are the biggest changes for the 2025 tax season. So definitely pay attention here. If you have any questions, put them in the chat. We'd be happy to address them. So the biggest thing on the One Big Beautiful Bill, they say it's a One Big Beautiful Bill, and it's really because there's a lot in it. The nice thing about it is a lot of the bill is just keeping the same what had already been put into place with the Tax Cuts and Jobs Act of 2017. So if you remember, the Tax Cuts and Jobs Act of 2017 was set to expire after 2025. So for example, the higher standard deductions, the tax rates, qualified business income, all of these things that we've grown to love and get used to. If you remember, the standard deduction for married filing joint was, I think, $10,000 in 2017, and it went up to like $25,000. So it's set to be about $30,000 this year. So we're going to revert back to about $10,000 and lose that deduction if this wasn't continued. So it doesn't sound that neat, doesn't sound that great, but there is a lot of things that were put into place to just maintain what we've already had. So the first thing here being the new higher standard deduction. So it's really keeping it the same, and it's adjusted for inflation. So in 2025, it'll be $31,500 for married filing joint. It basically just keeps those higher rates. So if you're looking for some tax planning ideas here and you do charitable contributions, you can bunch your itemized deductions, whether it's property taxes, you pay 2 property bills, one in January, one in December. You can double up on your property taxes. There's lots of strategies like that that can be helpful. Same thing with tax rates. Rather than having that tax cliff falling off, those tax rates are now still set to continue with inflation, and it's now made permanent. So it will no longer sunset. That's another thing to note with a lot of these tax laws is some of them are for just 25, 26, and 27. A lot expire in 28. Some may sunset after a certain period of time, and some are locked in permanently. And when I say permanently, that doesn't mean forever and ever. Congress can still step these back. They can still make changes, but they would have to pass laws to make them different. So because we now have locked in tax rates that are still lower and the brackets are larger, it may be a good idea to look at Roth conversions if you want to lock in some of those lower tax dollars and help with your retirement planning. With the child tax credit, it has been increased from $2,000 to $2,200, and that will be indexed annually with inflation. So that's another one that we haven't seen a step up quite that big on the child tax credit. That'll be a good one. Anything else on those 3? Kathy?
I think that one thing I'd like to mention is with the tax rate, it's kind of just keeping it the same as it was. There was a lot of kind of misconception, I think, about the One Big Beautiful Bill, that it was only for businesses or that it was only for the extremely wealthy. But these tax rates, even though it's not a big change, it it would have been a big change if the one big beautiful bill had not stepped in and said that these are now our permanent tax rates, because they were going to go back to the 2017 level, and you would have gotten into a higher tax bracket. No matter where you started on the bracket system, you would have been in a higher bracket much quicker. And just kind of keeping that in mind, that even though it's not really a tax cut, it really is a tax cut over what it could have been.
That's perfect. And then the last one on this slide, this is specifically for people in that 37% tax bracket, which is the highest one. So if you have $751,000 or more of annual income, it just changes how you do your itemized deductions. So just a note on there. We did have a question here, so we're about to address that question about the tax, or is there a tax deduction for Social Security receivers over 65? So essentially, no, but in a way, yes. So one of the big things in the media, they said there was going to be no tax on Social Security. That did not happen. Social Security is still taxed if your income is over a certain threshold. But what did happen is there's an additional $6,000 deduction for anyone over age 65, but the phase-out income starts at $75,000 if you're a single filer, or over $150,000 if you're married filing joint. So this is a deduction on top of the standard or itemized deduction. So it essentially covers the taxes on what you would have been taxed on Social Security. So in a way, the answer is yes, but your Social Security is still taxed. Charitable deductions for non-itemizers. So this is after 2025. So starting in 2026, you get $1,000 a single filer or $2,000 married filing joint on any donations, even if you don't itemize. So to clarify what those are, if you itemize, you get to take all the individual expenses, and it has to exceed the standard deduction before it gets credit. Otherwise, you just take the standard deduction and you get that flat amount, kind of as a gimme. So what this new rule is saying, even if you take the standard deduction, you can take a $2,000 married filing joint donation for any donations you do make. So kind of a neat little thing, but there is also a 0.5% floor for charitable contributions. So something to look out for.
One thing I'll jump in on that 5% floor. The 5% floor counts if you are itemizing. It does not apply to the non-itemizers amount. So if you have the $1,000 or the $2,000 and you're not itemizing, you don't have to deduct the 5%, the 0.5% floor on that one. It's only if you are doing regular itemized deductions.
Good point. This next one here, bottom left, tips and overtime. This is probably one that has been very, very popular in the media. There's been a lot of controversy of how it's going to be reported, and it's been kind of a headache. But the nice thing is, if you work a job that receives and reports tips as well as overtime, you may be eligible to not pay taxes on this. So you get up to $25,000 in tips and $12,500 in overtime pay, or for single filers, or $25,000 as a married filing joint, essentially deducted. You wouldn't pay taxes on those tips. So if you're in the restaurant industry or a service industry that collects tips or overtime, this is hugely beneficial. You still report on your income taxes on your 1040. Just make sure you bring your final pay stub that shows the amount of overtime you've worked or the amount of tips you claimed. If you don't show it on your pay stub, you'll need to contact your employer to get that information, because we will need this to make sure you get the deduction properly. For the U.S. auto loan interest, this is new from 2025 to 2028. Basically, you can deduct up to $10,000 per year if it's a U.S. assembled car. There is phase-out limits there, but if you decide to purchase a vehicle in those years, there's some additional deductions. This one here is probably one of the things I'm most excited about, that I think, as talking with people in the state of Texas, we have no state income tax, which is great, but we have very high property taxes, which is not so great. So previously, if you had a home in Texas, you would likely be capped at the amount of property taxes you can claim on your tax return if you're itemizing. So that cap was $10,000 for SALT taxes, state and local tax. So that cap has gone from $10,000 to $40,000. And this is only from 2025 through 2029. So this is also not permanent. There is a phase out if your income is over $500,000, but you never phase below $10,000 of that cap. So this is very, very helpful if you have a high, either state income tax, property taxes, whatever the case may be. So just be aware as you're doing Roth conversions, if you're doing retirement distributions, that you're not going above this threshold. This example down here says if you go from $500,000 to $600,000, so let's say you take a $100,000 401k cash out, it basically reduces the SALT deduction from $40,000 down to $10,000. It increases your taxes by $45,000 by distributing that $100,000. So it's almost a 50% tax rate just by poor planning. So watch out for those phase out limits. They are very, very impactful. Qualified opportunity zones is a good one if you're looking to basically either defer or get rid of capital gains. This is a really good one to be aware of. There's a lot of changes, and it will you can either defer partially or completely those capital gains. A couple other items here on Trump accounts. So this one has also been in the media. These are essentially almost like an IRA where you can, it's a savings account for children born from 2025 to 2028. Each newborn receives a $1,000 deposit. That doesn't mean that if you weren't born that year, you can't do it. You can open these for other accounts. I'm sorry, for other children, but they don't get that $1,000. So parents can contribute to it. Even employers can contribute to these. There's different ways that can happen. So think of this almost like a traditional IRA that you don't need earned income for. You can contribute to this, and it's got different withdrawal permissions up until they're 18. You can use certain things for education, and then up through 30, and then it's got a little bit more flexibility than an IRA does, but it's a little bit of a different purpose. And then mortgage interest and casualty deductions. So the $750,000 mortgage interest limit and suspension of personal casualty loss deductions are made permanent. 529 plans have changed, and also estate planning and gift planning under the One Big Beautiful Bill have changed. So if you have a 529, you can now use this for elementary, even high school education. And with the estate and gift planning, the exemption is now to $15 million or $30 million per couple. So there's a lot of talks if that was going to drop down after the Tax Cuts and Jobs Act expired. It was increased. So this is very helpful if you're in that network range. Anything to add on those ones, Kathy?
I don't think so.
Okay, business depreciation. I said SALT tax was probably the biggest one, but I think business depreciation might be bigger. So if you own a business and you aren't aware of how bonus depreciation works and how this changed with the Tax Cuts and Jobs, or with the One Big Beautiful Bill, I would strongly encourage you to look into it. So you can now bonus depreciate up to 100% of your business assets in the year that it's placed in service. So if you remember back to, I think it was 2020 was the last time we had 100%, and it went down to 80%, then 60, then 40. This year was going to be 40% depreciation, but it's back up to 2020. So for 2025. So from January 1st through January 18th, it's still at 40%, but on January 19th, Inauguration Day, it is back up to 100%, and it will stay that way moving forward. So this is really important to, if you're purchasing buildings, you can do a cost segregation and you can depreciate things faster. You can also strategically use between Section 179 and bonus depreciation, two different strategies that have a lot of overlap. And this is really helpful if you have certain higher income years, certain lower income years, you can smooth it out to make those tax brackets a little bit more advantageous for you. Even just timing of asset purchases. We had a client, I think it was at end of 2025 or end of 2024, December 31st, buying a vehicle because she wanted to purchase the vehicle and bonus depreciate it in that year to reduce some income because it's a higher income year. There's a lot of strategies that can go around with bonus depreciation. This one also goes with it. If you're a real estate professional, there's other things you can do with rental properties. And we mentioned cost segregation, that's a big one. And then QBI is a really big one. This is one we've gotten used to, and it was set to phase out after 2025. It is now made permanent. So So QBI is really the best kind of deduction. It is one where you don't have to spend any money to get the deduction. It is a 20% deduction on your profits. So that was about to go away. So if you made $100,000 of income, you were about to lose a $20,000 deduction. So if you're at 20% tax rates, that would hurt a little bit. So there is phase out limits for that, as you can see on the screen here. There's also a $400 minimum threshold. So even if your profit is below that, you still get a $400 QBI deduction. So just something to be aware of. Make sure you're claiming on your tax return. If we're doing your taxes, we'll make sure you're covered. But if someone else is doing it, or you're doing kind of a DIY solution, make sure you pay attention to qualified business income. Really good deduction. Qualified small business stock. Won't go into this one too much, but it's largely underused and skipped. A lot of times people think this is just for large tech companies, but this can also apply to different companies, HVAC, electricians, doctors, you name it. And this allows you to have 100% capital gains exclusion up to $15 million if you hold the asset for 5 years or longer. So kind of a capital gains deferral or exclusion. And then R&D credit or R&D expense for deductions. So this is another one that changed. We had it before. It wasn't quite as great for the last couple of years. It is now reversed to those pre-2022 rules. So this is also very beneficial if you haven't done R&D expense deduction. If that's something you're interested in, please let us know. We can see if this would be a good fit, and we can coach you through what documentation, things like that may be helpful. I will skip these couple of slides just for the sake of time. These are a few different scenarios. I'll post the slides online, so if you want to look through them, you can see a few different scenarios. I want to open it up for a few questions if you have any. But one last reminder is you're putting your questions in the chat here. Tax planning is like a GPS. So everyone's moving down the road. You're going to have to file taxes no matter what. If you're making a wrong turn, just make sure you get back on course. You're planning for it, not reacting. So you're planning ahead. So whenever it says recalculating, get back on course as fast as possible. So the One Big Beautiful Bill is one of those kind of pivots that we've got to turn around. There's lots of new opportunities with it, so make sure you learn it and you stay ahead of those 2025 rules. Yep, any questions? Kathy, do you have something to add there?
I was going to say about the, just making sure that you're planning ahead. If you do get off course, say you had something happened, you didn't file 1 year, or you filed a return and then you realized later that you'd missed a significant portion of income or anything like that. Those kind of things don't ever really go away. And especially if you compound it by thinking, oh gosh, I didn't file last year, so I can't file this year. It's important to get back on track with that as soon as possible. There are interest and penalties involved in that. The IRS could take a harder look at what you do file if you get into those situations. So if you do get off track, use that GPS to get back on track as soon as you can.
Perfect. Okay, I'm not seeing any new questions coming in, so hopefully we addressed everything during the webinar. If there's anything we didn't answer specifically during this webinar, it may be because it's a little too specific to your situation. We'll reach out to you directly. But if you'd like to contact us, if you're a business owner and want to meet with us, feel free to scan that QR code. We can do a tax consultation with you. And if you're looking to do your tax return or you're returning client, feel free to email us or give us a call at that information on the screen. But best of luck this tax season, and we're excited to work with you. Have a great day.
Have a nice day. Bye-bye.